people coming in and joining the webinar now. So I'll just give you a few more moments to be getting yourselves logged on and ready for what's going to be a thrilling end of tax year explanation from Dan, and also an update on investments that we're going to get from Shane. So Dan, do you want to start the slides for us then? So just a quick overview of today then of what's going to happen on this webinar. Is obviously just to remind you that your microphone and cameras, they're all turned off, so don't worry, we can't see yourself on the screen, and also can't hear what you're saying from there. If you've got any questions, either email them through to our client service email where we'll see them, or you can put them in the questions and answers box down at the bottom of the screen, and we'll pick them up and answer them for you as best as we can. We're probably going to spend 10-15 minutes talking to you about what Berry & Oak have been doing and some tax year end planning, and then about 30 to 40 minutes from Shane talking about what's happening in the investment world, and some time for questions at the end. At the end, as you leave the webinar, there will be some feedback questions that we always find really useful, and we do use them to help plan your future events. So please do spend a few moments telling us how you found the event, any ideas for improvement, so we can make sure you get the best value from these. So moving on, Berry & Oak. Well, it's hard to believe that today's the 1st of March. The year's been so busy. Lots of things have gone on, but I thought I'd just let you know a few sort of big successes that have happened for the team lately. First, and really, really proud that Dan has finally achieved his Chartered Financial Planner status, which is like the pinnacle of being a financial planner. It's a lot of hard work that goes into that, from both examinations, but also proving the sort of value of the advice that he's giving and the time served in the profession. And he's signed up now to the code of conduct that's special for chartered financial planners. We've also had some exam successes. Rebecca has passed 5 of the 6 exams to get her diploma, and she'll have her fingers crossed for this Friday when she finds out the result of the 6th one. We've got lots of confidence in her that she's done well, and it'll be a fantastic achievement for her to have achieved the diploma, considering she only joined the profession about 15-16 months ago. Dan's back on here again. Dan, the exam man, has also passed the equity release and long-term care. So some extra specialism he's got to be able to help. And then something that we're really, really proud of, we're very fortunate to be awarded the Citywide New Model Advisor of the Year award again for the North of England. Especially as the North of England covers from all the way from sort of over in Hull, all the way over to sort of Liverpool, Manchester way, and up north. So it's a very big part of the country, but to win it for 5 times has been amazing. Probably the only thing that's a bit disappointing about it is this year they changed the logo. So we've had 4 nice orange logos. We've now got a very, very different logo. But it seems to be, doesn't matter what the logo, the team here worked so hard to be able to have won it. So what we're going to go on to next, tax year end planning. We've only got 4 or 5 weeks left for the tax year. Hopefully for most people, a lot of the things we're going to talk to you about today have already been done. For a few, it might just be a quick reminder of some things, and there's a bit of time to get them finished off. Good tax year planning, it is an all year round event, not just at the end of the tax year. This is just almost like a catch up to make sure nothing's been missed. It'll be very interesting to see what's happening in the budget in a couple of weeks, and whether that might affect some of the tax year end stuff that people do in future years. But what's very, very obvious is tax is becoming a bigger and bigger part of financial planning now, as tax rates rise, allowances reduce, and it is very, very important to make sure you use all the available allowances that you do have. So I'm going to hand over to Dan now, who's going to run through some of these special exemptions that are available and give you an update.
Yeah, thanks very much, Andrew, and hello everyone. Welcome to the webinar. As Andrew said, I'm going to hit these 6 different points and let you know a bit more detail about what you can do. As Andrew said, for a lot of clients, we'll be talking to you about this kind of thing all the time in your meetings, and making sure that you're using as many of your allowances as possible to make sure that more of your money stays in your and your family's pockets. So the first thing is really ISA allowances. So you can pay in, as each individual can pay in £20,000 into an ISA per tax year, and that's either into a cash ISA or a stocks and shares ISA are the main two categories, or you can pay in a bit to one and a bit to the other. One thing to say is, which is the top point, in previous years, the rates on cash ISAs have been pretty disappointing. So the amount of interest that would have been generated would have been within your personal savings allowance anyway, making the ISA wrapper not really worth too much. But now with interest rates rises and the amount of interest that you're going to potentially get even on a cash ISA, it means actually it's definitely worth doing, making sure you use that ISA allowance. The other type of ISA then for children, maybe grandchildren, is the junior ISA. And again, you can do either a cash junior ISA or a stocks and shares junior ISA. And you can pay in now, the allowance has actually gone up to £9,000 a year into a junior ISA. And that might be worth considering, again, just to make sure, you know, as a whole family unit, if you use your 20,000, consider using your whatever children or grandchildren you might have, use their junior ISA allowance just to get more funds into that tax-free ISA environment. And this is, you need to do this by the 5th of April this year. So if you haven't already done it and you've got some cash to use, make sure you do it. Even if you're not sure if you want to invest it into a stocks and shares ISA, maybe just put it into a cash ISA, and then at a later date, if you do decide actually want to invest it, then it's relatively straightforward. You could do a straightforward ISA transfer just from the cash ISA to the stocks and shares ISA, but you've made sure you've used your ISA allowance. So that's ISAs. The next one then is the personal income tax allowance. So each individual has an allowance of £12,570 per tax year that you can take income, and within that personal tax allowance, you don't pay any income tax on that. And this is an allowance, again, if you don't use it in one tax year, it's gone. You can't go back and use it from the previous tax year. And there are a few ways that you can kind of fill up or generate income to use this this allowance. So the first one is pension withdrawals. If you've got a pension pot, and you don't have any other income, either from employment income or rental income or anything like that, it might be that you've got the whole 12,570 with allowance to use, and you can take a taxable income withdrawal from your pension to make sure that you're getting as much into your own pocket really from the pension tax free. Another one then is if you've got any onshore or offshore bonds, you could potentially look at encashing some of those bonds, because the chargeable gain on those bonds would come into your income tax calculation. And if you've got no other income, then you can use your personal income tax allowance to make sure you don't pay much tax on those bond encashments. The third one down then is dividends. If you're a business owner or have shares in a company where you can control the level of dividends that you take from that company, definitely worth considering withdrawing some dividends to make sure you go up to that personal income tax allowance of 12,570. Make sure you use that allowance. And then the fourth point here is, if you're a married couple, you can, as far as is possible, try and split your assets and from which the income is generated, to make sure that you use both husband and wife, both spouses' allowances. So you've got potentially 2 personal income tax allowances to try and use if you are a married couple. The next one then is pensions annual allowance, which does get very complex. It's quite a busy slide, but I'll just take you through the basics. But essentially, pensions annual allowance is what any individual can pay into their pension in a given tax year. And generally speaking, you can contribute up to your earned income or up to £40,000, whichever of the two is lowest. If you don't have any income at all, then you can pay in £3,600 gross, which is £2,880 net of basic rate tax relief, and then you get the 20% basic rate tax relief, which takes it up to 3,600. And this is really worth considering if you're retired and you no longer have any income, or the lower or non-earning spouse can do this, and you can even do it for grandchildren or children. Likely, if you've got young children in the family, they're not going to have any income, but you can still put money into a pension for them up to that 3,600 limit. So again, using the whole family's tax allowances can be really beneficial. Anything that goes into the pension can grow free of tax until you come to take out the pension when you retire, and then it comes into income tax. So tax relief I've touched on. When you put money into the pension, that automatically gets topped up with the 20% basic rate tax relief. If you're a higher or additional rate taxpayer, then you can claim higher rates or additional rate tax relief through your tax return. And one band to be really careful of is if your total income is between 100 and just over £125,000. At that level, your personal allowance gets withdrawn on a gradual basis. So if you're between 100 and 125,000 of income, your effective tax rate is 60% on that band of income. So definitely worth considering using your pension annual allowance if that is you. Annual allowance can be complex if you're very high earners, kind of touching on £200,000 plus of income in a tax year, and at that point it gets tapered down the amount you can pay into a pension. But come and speak to us about that, and we can help you work out what that situation might be. And the thing is, with pensions annual allowance, you can carry it forward from the previous 3 tax years. So it's not just a case of this tax year you want to make sure you use, but going back 3 tax years as well. Make sure you use those allowances where possible. The next one then is paying missed voluntary national insurance contributions, and this is to ensure that as far as possible you're going to get the full state pension. So you can get your own forecast online, and that's through the government gateway. And again, if you haven't done this is something we can definitely help you with. And you can, if you don't have the full amount of national insurance contributions from previous tax years, and you're no longer building them up through working, you can buy what's called Class 3 national insurance contributions to top up your national insurance contributions from previous tax years. But from next tax year, so from the 6th of April 23, you'll only be able to go back 6 years. So if you might need to buy a few national insurance contribution years, then you need to make sure you check and go back to 2016-17 before the 6th of April to make sure you will be able to get the full state pension. To get the full state pension, you need 35 full years of national insurance contributions at the current rate to get the full state pension. And if you do need to buy previous years of national insurance contributions, broadly speaking, one individual year will cost you about £800, and that will get you an extra about £5 a week of extra state pension. So when we generally work it out, if an individual lives about 3.5 years plus above state pension age, then it works out to have been a good investment. So it's well worth considering. And when you come to do this, some years are better than others to buy looking back, but if you ring the Department of Work and Pensions, you ring their number to buy the extra years, they'll be able to take you through it and let you know which years are best to buy. So that's national insurance and state pensions. Next, I'll come on to capital gains tax allowances. And this was one of the big changes in the most recent budget. The allowance for this tax year for realised capital gains is £12,300 per person. But next tax year, so 23 to 24, that's reducing to £6,000 only per person. And then the tax year after that, so 24, 25, that's going to reduce to 3,000. So it's really going to reduce the amount of capital gains you can realise with investments that aren't in ISAs or pensions, so investments in general investment accounts, or in any other assets that you might have that are subject to capital gains tax, such as property. So really, this tax year is your last chance to use that 12,300 allowance before it reduces. So definitely need to consider what you can do to use that allowance if you do have investments that aren't in pensions or ISAs. There's a few things you might be able to do. So you could sell assets before the 5th of April and then reinvest them, either in an ISA if you've got your ISA allowance to use, pension if you've got the pension allowance to use, or you could consider a bond to invest outside of the general investment account. Or you could simply sell the asset, sell the fund or share, wait 30 days, and then buy it back again. If you do it before 30 days is up, it doesn't count. That's the rule they use to stop people just selling things one day, buying things back the following day or the same day. Or you could invest in something similar. So you might have one fund that you've got a gain on that you want to sell, and you might sell it and buy a similar fund, and that in that way you'd be able to realise that gain. Again, interspousal, you can make interspousal transfers. So if husband has a fund that's got a big gain on it that he wants to realise, but he's already used his capital gains tax allowance, he can transfer it to his wife, and that interspousal transfer is no gain, no loss, so no tax to pay on that transfer. The wife can then sell it in her name and use her capital gains tax allowance. So again, making sure that the whole family's allowances have been used. And the other thing to consider is any capital gains realised above the allowance of 12,300, they kind of sit on top of the income tax that you have in a given tax year, and anything above the allowance of 12,300 but still below the basic rate of income tax, so below 50,000 when added to your income, it's still, the capital gains tax payable is at 10%, which is still quite low. Income tax at basic rate is 20%, and so it's a relatively low tax percentage to pay. So it might be worth considering, if you've got a lot of gains built up, is even taking the hit on 10% capital gains tax worth it, and realizing even more gain before the allowance is reduced next tax year? And there's always rumblings, the 10% may increase in the future, so you might want to consider accepting a capital gains tax rate of 10% at this time before it reduces, before it increases potentially. So that's capital gains tax. And the last one then is on inheritance tax. So there are a few annual allowances that you can use for inheritance tax to make gifts or transfers to people that are immediately exempt, so immediately outside of your estate. The main one then is any individual can give away £3,000 per tax year, and it's immediately exempt from inheritance tax and outside of the estate completely. You can carry this back and use last year's allowance as well if you didn't use it. So potentially you can give away £6,000 and it's immediately outside of your taxable estate. You can make smaller gifts of £250 to anybody in a given tax year. So you can consider doing that before the 5th of April. And a common misconception with inheritance tax and gifting is you can give away more than this. You can give away as much as you like, but anything you give away above these allowances stays in your estate for 7 years. So the £3,000 allowance doesn't mean you can only give away £3,000. It means you can give away any amount, but the first £3,000 is immediately exempt from inheritance tax. The rest of the gift stays in your estate for 7 years. And the important thing to cover on this is make sure if you are doing this, you keep good records, and there's some forms that we can help you with, or you could do it via a spreadsheet, because hopefully nothing will be investigated, but if in the future anything was investigated, it's really good to have these records and these forms to fall back on, and it just sets it out nice and clearly. So that's everything I had to cover on using your allowances as far as possible before tax year end. And as we said, if there's anything that you have any questions on, or anything that you think we can help you with, then please don't hesitate to ask the question and get in touch with us all here at Berry and Oak. And now I will hand over to our next presenter, who I'm sure many of you have seen and met before at previous events. So Shane Balcombe is the Chief Investment Officer at U Asset Management. And Shane and the team at U Asset Management look over many of our clients' portfolios, and we're really happy to have Shane back here today to talk to us about investments and stock markets and what's happened and what may happen in the future. So I'll now hand over to Shane.
Thank you, Dan. Thank you, Andrew. This is where it goes terribly wrong as I try and share my screen. No, that's the wrong one. I told you it'd go wrong. Excellent. Hope everyone can see that well. Welcome, everyone. It's lovely to be able to present to you again. It was great to see everyone that was at the seminar last year. It's gone ever so quickly, as Andrew already said. We are in March already. It's scary to believe that. I'm going to go through what were the current major factors driving markets last year and what returns have been delivered over that period. And then also look at the more tricky area of what we think is going to happen this year and beyond. As Andrew said, there's opportunities for answering questions at the end as well. Diversification, in our view, has always been a significant factor for us. We look to build globally diversified multi-asset solutions. And what you have here is a table showing you two major asset classes. In the orange is world equities, and in the grey is world bonds. And you can see going back to 2011, where world equities had a negative return, bonds conversely had a positive return. And that's the sort of relationship you're looking for. It doesn't always happen, but more often than not, when equities are doing well, bonds aren't doing as well. But if equities absolutely crash, then bonds come in with a sort of set of armbands to keep your portfolios afloat. And you can see that through 2011 all the way through 2021. In particular, 18 and 11, you can see here that when we had negative years for equities, bonds produced that positive return for you. Now, if you closely look at 2022, you can see there that equities were down 8%, but bonds themselves were down 12%. And that shows you what an incredibly difficult year 2022 was. Not only were we having to understand how central banks were going to fight inflation from a position of being asleep at the wheel to a degree, we also had issues with supply chains still being stuck through COVID and the conflict we had in Ukraine making matters even worse. So even though diversification mattered, it broke ever so slightly in 2022. So it's really important to make sure when you're building these asset classes, these building blocks for portfolios, that you don't just have these two core portfolios. Within bonds, you want to use other things as well, such as infrastructure, commodities, absolute returns. And within equities, you want to make sure you're diversified geographically as well as through factors as well. So even though equities in general were down about 8% last year, different factors drive them. Typically, the two main factors for driving equities are growth equities and value equities. Growth equities tend to be those names that are synonymous with tech. and value tends to be more synonymous with more traditional companies. Tends to be more like consumer staples, tend to be those, you might consider them dull. They've been around for a long time. They will generate lots of income. And you can see here, going back again to 2011, that they tend to switch sides. Ironically, in 2011, sort of coming off the back of the global financial crisis, they both did the same, both negative. But you can see then growth was generally the main player throughout that period. Prior to the global financial crisis, value was the key player in sort of the late 1990s, early 2000s. Now we want to build portfolios, and the way we build portfolios is to have a blend of both equity and bonds, and a blend of both growth and value. And in 2020, we started to build up our value portion that we have in our portfolios. And you can see there in 2021, value just outperformed growth, but hey, who's going to grumble? Value did 20 and growth did just 18. However, last year, in a negative year for equities, value equities did a positive return, 4%, and growth was down almost 20. And when you had that rotation at the beginning of 2022, where equities that had done well in 2020 and 2021, after the pandemic stimulus had been put into place, in an area where they do well is in low interest rates, but in a rising interest rate environment, value equities tend to do better. And that's why we were building up our store of value equities, because we believed at some point the central banks are going to have to start raising rates, and that's what we saw in 2022. Diversification also matters within that equity content, value and growth. You want to look at both geographical areas. You also want to look at large cap and small cap areas as well. You want to make sure you're as diversified as possibly you can. Looking at the geographies here in 2022, you can see here actually the UK FTSE All-Share was the only positive geographical area in the globe. Squeaked in at 0.3 plus, which was really good. UK and Japan were our overweight positions going through 2022, and they were the two best performing asset classes there. Generally for the UK, it was helped by commodity producers, defensive consumer staple companies. What are they? They're companies that produce stuff that you need rather than you want. So you might want an Apple iPhone, but you don't need an Apple iPhone, even though I tell my children that. But you do need to eat. You probably do need to add fuel to your car. You do need to heat the home. These are the things that were doing well, and probably the most expensive as well throughout 2022 because of inflation. Sterling also helped us as investors. And if we convert those returns into sterling returns, so that is translating overseas earnings back into sterling, you can see here that Europe, emerging markets, global equities, and US all did better when you convert them back to sterling because sterling depreciated. So we got this kicker, this boost from pushing stuff in from local currency into sterling, apart from Japan. Japan's currency depreciated more than sterling over 2022. And what do you want to end up with this diversification? This is what we call our quilt of asset classes, is to make sure you're not reliant on only one individual asset class. And you can see here, the very top box, hopefully you can see, in 2011 was inflation. And if you look there, that was quite near the bottom in sort of 16, 17, 18, and again came towards the top again last year as well. You can see there emerging markets was the best asset class in 16, 17, and one of the worst asset classes to be in 2021 and 2022. Ironically, going forward, we think global emerging markets is an attractive area to be invested in at this moment. What you want to end up with is those dark blue lines represent our sort of middle of the road balanced investment solution. So you never want to be top and you don't want to be bottom. And if you can be middle of the road over the longer periods of time, you end up with some really good outcomes for clients. So in summary, where were we during 2022? Inflation again was the main concern, and that's why you saw central banks move to try and combat inflation. They were a little bit slow. They should have been acting arguably summer of 2021 when inflation started to creep up, but they're a little bit slow. Hence, well, we've had the majority of all the interest rate rises in 2022 rather than spread out 22, 23, and 24. We've seen the central bank already raise one 25 basis point raise in the US. We expect them potentially to do another 25 basis points and then potentially pause. But it's all reliant on data. We've had some strong data come through. Unfortunately, it sounds counterintuitive, and we'll come through to that on the outlook point. So that is our summary for what has happened. It was a negative year, but we did slightly better than sort of the averages, and we'll come on to that now. So in the last quarter of 2022, it was positive. We'd had 3 negative quarters in a row, the first time we'd had 3 negative quarters in a row since we launched 2 decades ago, even though quarter 3 was only just slightly negative, but it was good to have a positive quarter to end the year. And you can see here what we've done again is the green is portfolio 3, the tealy color is portfolio 5, the pink is portfolio 8, and the purple is portfolio 10. It's easier to see if you just spread them out like that rather than having all 10 mixed up in there. Most importantly, all the portfolios follow in path. So if you're looking for your portfolio 4, guess what? It's bang in between the green and the teal line. So good end to the year. This year to date so far, all positive for all of the portfolios, whether you're in active or passive. So that's really encouraging as well. January was a very good month. February has been fairly volatile as some of this data is coming through, and I'll talk about that more in the outlook. But it came in roughly flat. So fingers crossed we could start the year with a positive quarter, which will be lovely. But overall for the year, you can see here the year here, negative performance. Portfolios 8 and 10, roughly down about 8%, 7.5 to 8%. Portfolios 3 to 5, just over under 5%. Now compare that to world equities for the year of 2022, they were down 16. And the average fund, if you take the average fund, that was down roughly 10%, just over 10%. So a negative year, but we've done slightly better than the peer group and the averages, which is really important. But it is about longer term investing. You see here the 3 and the 5 years starting to look a little bit more healthier, but you can see how volatile 2022 has been for the performance. And it's even starker picture if we take this back to the launch of the active portfolios. You can see here, hopefully on the cursor, you can see that how volatile, sort of like a reading for sort of a seismic reading, how volatile 2022 has been. And it's tested the metal of a lot of investments out there. It was interesting to read today that Vanguard is closing its financial planning arm after a couple of years. Now, this is over 18 years and 2 months. So over that period, we beat cash. So you're better off investing with us than keeping your money in the bank. Inflation has crept up, but all the portfolios have beaten inflation over that period, which is really important. And the bellwether index that a lot of investors tend to sort of listen to, and it's probably the only one that's ever mentioned in the news, is the FTSE 100. And the higher risk portfolios, 6 and above, have beat the FTSE 100, taking less risk and being more diversified. So that's really important. Very similar picture for the passive portfolios. Again, a positive end to the year, positive quarter, but overall a negative 2022. But again, outperforming the averages and outperforming the sort of global equity content as well. So even though it was a negative year, we've sort of got a head start going forward into 2023. And again, all the portfolios for the passive range are positive so far this year. So that's really encouraging. Over 3 years and 5 years, starting to look a bit healthier. And again, since launch of the passive portfolios, they will hit their 10th anniversary on the 2nd of April this year. So running those for a decade. And you can see here again, very similar picture. Better invested over the long term in these portfolios than you are in cash. Over the long term, beating inflation if you're taking a slightly more risk. The portfolios 1 and 2 slightly underperforming inflation, but inflation was, you know, the best performing asset class last year. That will come down. That will come down. And the FTSE 100 not having a great decade, albeit the FTSE 100 having a pretty good 2021 and 2022, but starting from a really low base, pretty much from Brexit, really. So that's the review. We're going to go into the outlook now for 2023 and beyond. Still can't believe we're already 2 months into this year already. But there are reasons to be optimistic. First off, we have some expectations that we're going to see from the central banks. We knew going into 2022 that we're going to start raising interest rates. What we didn't overly anticipate was how aggressive they're going to be, because they were massively behind the curve. And you can see here, the rate rises in 2022 are almost in a directly straight line up, parabolic. Market expectations for those rate rises are coming down to here. They expect rate rises to start being cut this year and going into 2024. Now that's important because the Federal Reserve issue their own guidance on when they think rates are going to be. And in the blue dots, this is where the Federal Reserve guidance comes in as well. The Federal Reserve isn't saying, no, the market's got it wrong. And when Jerome Powell came out on the 1st of February after their latest rate hike, he didn't correct the market expectations either. So we are encouraged that at some point, the central banks will start to cut rates. We have a sneaky suspicion it might be the UK first. I mean, we started raising rates prior to the US, but US is the most important, most dominant central bank in the world. So we have to heed what they're saying as well. So we'd probably expect one more rate hike this year, potentially in March. They're getting together on the 15th of March. UK's Bank of England is getting together on the 16th of March. So middle of March, just before Easter, just before your important tax year end decisions. We expect one more rate hike and then potentially a pause, but it will be data dependent. Market expectations for inflation coming down can be seen here. They're expected to come down quite rapidly over 2023. We had the peak in inflation in the US back in June. So we've had 9 consecutive months of falling inflation. Still high, inflation is still high, but we expect that still to come down. We expect the same to happen in the Eurozone and the UK. Why do we think that? Supply and demand. Now, supply was broken during COVID. If you remember, we had factories being closed down, people being socially restricted, people in lockdown. This had an effect on global supply chains. Anyone trying to buy semiconductors, so car manufacturers trying to buy semiconductors, weren't able to. Hence why you weren't really able to buy a new car in 2020 and mainly 2021. Hence why the price of used cars went absolutely through the roof, and why inflation was being pushed higher and higher. But a lot of these inflation measures were sort of one-offs. If you've bought a car, if you bought a television, if you bought a fridge, all of these contain semiconductors. You're not going to be buying these year on year on. So a lot of these prices are naturally coming down. So you've got a lot of the core inflation starting to come down. The sort of more volatile inflation, inflation that can go up and down very quickly, it tends to be energy and food, and they've been exacerbated by the conflict we had in Ukraine. Now, we've had a year of the conflict. Who knows what Vladimir Putin's going to do? Unfortunately, we live in a world where markets tend to now dismiss the conflict as a risk. It's in the background. If it escalates, it'll come front and center, but it's not something we can sort of focus on too much. But we're getting to healing supply chains, which is bringing down inflation. What we do still have, though, is high demand, and that's come through with job vacancies. The labour market is still extremely strong in both the UK and the US, and this is the last sticking point for central banks before they start to stop raising interest rates. And this means demand is still high. Now, what we're seeing here, just slightly, is the number of vacancies relative to the number of unemployed. So this is the number of jobs available to the number of people seeking jobs. And you can see in the US, towards the end of 2022, it hit almost 2 jobs for every 1 person looking for a job. In the UK, it hit 1 job, just over 1 job available for people looking for work. So unemployment was very low. Labour markets were very tight. And perversely, what you want to see, what the central banks want to see is, ironically, a little bit more unemployment, which will soften demand, and hopefully that will allow them to lower interest rates. And we're starting to see that, he says, if the slide moves on. There we go. We're starting to see that a lot of the companies' fourth quarter earning releases, where they give announcements on how tight labour markets are here. And you can see here, this shows you the amount of management citing there were labour shortages. And at the sort of height of the pandemic, sort of, 16-17% of the market was saying there were huge labour shortages. That's come down dramatically to 5%. Still not anywhere near where the level was before COVID, but I think you'll see that start to come down. So there's important data points to give us optimism that over the next couple of months, the next couple of meetings with central banks, we should get that rhetoric that inflation start coming down. Caveat that with the central bank's only concern is to make sure inflation is absolutely beaten. So I think you might get a situation where you get a rate rise, but maybe the language still is a little bit, say, hawkish, a little bit more threatening to say there could be rate rises in the future, just to dampen inflation expectations. That's the key. I think you'll see a relatively long pause before then start cutting rates. And the reason they're going to start cutting rates is because they want to look to inject more growth into the economies, because we're in a situation where growth is slowing as well. China is open. Now, China was one of the main reasons why we had sort of blockages in supply chains through their zero COVID tolerance policy. So anytime there was an outbreak in China, they would immediately segregate that area and everything ground to a halt to stop the spread of COVID. Why? They hadn't had a very successful vaccine rollout. They were very reluctant to use Western vaccines, and they wanted to develop their own vaccines, which in the initial first trials weren't very effective. They now have a more effective vaccine, and they now have a more effective rollout of that. So there's a little bit of confidence there. And I think if you remember me talking last time, President Xi and the conference they had for the party, he got his 3rd unprecedented term, and that allowed him now to undo some of the policies he put into place. And we were always hopeful that they would open up China here. Now, we think this is going to be a boon to growth, a bit like in the West when restrictions reduced. There was this pent-up demand through something like 14 trillion worth of savings in the US and developed markets. China have a record 2.5 trillion of savings to deploy. Primarily, we think this is going to be in tourism and service sectors, which are the areas that got hit most hard. And they're the areas that are sort of come up in your value stocks rather than your growth stocks. So again, another reason to be diversified. Will that lead to more inflation with China opening? I don't know. We think it will. It possibly could, but I don't think it's going to affect the inflation areas of food and energy, which are the ones that we need to start coming down. Now, final reason to be optimistic is historic probabilities. Basically, the role we do is on managing probabilities. Probabilities show you that globally diversified multi-asset portfolios over the long term tend to outperform any other single strategy. And what we have here is the S&P 500's performance over since 1928, so over a considerable number of years, just showing you that what are the odds of having 2 negative years back to back. And you can see here that only 9% of the time since 1928 will you get a negative year followed by a negative year. So you've got an 81% chance 91% chance. There's me saying probabilities is something we do with a 91% chance that we will have a positive year in 2023. And backed up against all the other elements going forward, with inflation coming down, with supply chains healing, with a diversified portfolio, we are really positive in 2023 and beyond. Very important slide. Please make sure you read that. Thank you for attending the webinar. It's really good opportunity to speak to everyone again. And I'm going to turn the slides off now because it's time for questions.
Brilliant. Well, thank you very much for that, Shane. Very, very interesting looking back on what's happened with historical, but also, you know, some of the things we've talked about over the last 12 months, China's third term, inflation. I know central banks and getting it wrong was the big worry, and yep, they got it wrong.
Yep.
So being aware of that. Maybe quite a topical thing. There's been obviously a lot in the press this week about potential Northern Ireland Brexit deal coming to you know, into sort of force that might well work if everybody agrees to it. What sort of view do you think that might have on markets, and any particular markets especially?
Yeah, no, I think it's going to be good for the UK domestic market. We've been an unloved asset class pretty much since Brexit, and I think it took a lot of people by surprise that in 2022 we were the best performing asset class geographically. I think finally getting to the last elements of Brexit sorted and dealt with could be that catalyst to allow more people to invest in the UK, particularly with a depreciated currency as well. We're cheap for international investors. We're cheap. They should be buying us.
Brilliant. And a lot's been made of obviously the shift in the last couple of years between growth and value, and is it going backwards, etc. You know, your words on sort of diversification. What sort of triggers might be out there that says, yeah, we've moved from more value into growth?
Yeah, no, really good question. Growth tends to do well in a sort of static environment. Value tends to do well in a typically interest rate rising environment. We could argue when we get to the end of 2023, we could be out of a interest raising environment, and we could see some cuts from central banks. So you could see a situation where growth becomes a strong proponent again. I don't think it will be to the expense of value. So if you looked back in 2021, both growth and value did particularly well. And I think we could have another situation for a while where both growth and value stocks do particularly well, rather than one at the expense of the other one, which means, yeah, a lot of those franchises, a lot of those strategies that didn't do well in 2022 could come good again. We got an opportunity where we could cherry pick a few funds in 2022 that sort of been hit hard because of their growth characteristics, but we bought them because we think, great, these are still good funds, and over the next 3 to 5 years they're going to produce really good returns for our clients. Yeah,
and that probably raises an important topic, and something we talk to our clients a lot in meetings, that it is important to have a longer term view of investing. So sometimes, obviously 2022 was painful to look at whilst we're in it, but it does give you the opportunities to buy those investment funds that have dropped in value, and you think they're really good quality funds that you've now bought at a good price, and we just need a bit of time for them to be held in the portfolio to show those returns, and you know, that conviction of you almost buying them on sale. We need them to come back to their normal price. So it's difficult when we're, you know, clients and everyone is in that moment when it's just fallen and worrying about it. But you know, my sort of research analysis of past markets is actually the money is made when investments fall. You just need to make sure you put them in the right area and wait for it to recover. That's when you make the money.
No, absolutely. That's a really, really good description of the sort of the behavioral set that you need for long-term investing. I think perversely, it's the only time when things get cheap that people panic. If you were buying fine wine and you knew it was a really good vintage, and it suddenly was on a 20% discount, you'd hoover it up and then hold that wine until it became back to its true value. It's the same with investments, but the problem is it's very emotive. We are living in a world where information is instantly available to us and is put front and center in front of our faces, and the language all the media outlets use is immensely emotive to try and trigger us to click on that story or read that article. So yeah, it takes a lot of discipline, and to make sure you are partnered with fantastic financial advice firms such as Berry and Oak to make sure you can guide and lead your clients, Andrew, through the difficult times to allow them to enjoy the good times.
Absolutely, and thank you for that, Shane. I probably just need to pick you up on one point there, though, when you said you bought that wine at a really good discount and then you held on to it till it went up in price. You have met Sarah, you know, the wine would have been popped open straight away and we'd have just bought it at a discount.
It's the wine she doesn't know about, Andrew.
Okay. But no, but it is an important point, and I know we spoke to a lot of clients about it, is actually, if available, that was the time to find some money down the back of the sofa and put it into the market, and just give yourself enough time, it will come up. There are those guys that are at the other end of the spectrum, though, where they're looking to draw money out and worry that obviously with markets falling, it's not a good time to withdraw now. And that's when it's time to limit the withdrawals, so make them as small as possible. Consider using cash instead, and that's why we keep cash balances to use at a time of need to allow the investments to pick up and then top the cash up. Or sometimes, you know, if you've got £200,000 in your investments and you only need to draw £10,000 out, even though it wasn't a great time to withdraw it, it's not going to make a huge difference in the long term if you can leave the bulk of it invested.
Yeah, as you say, it's important to have management of that withdrawal process. Yeah.
And I think probably just the last point to pick up on as a bit of a question, point from you, Shane, again, picking up from what you said earlier, and I know you and I have both said the same thing for probably for 2 or 3 years now, is the amount of noise that's in the media of all that's gone on. As I said, to look at last year and say, you know, pretty much the FTSE hit an all-time record, would not have believed that, having listened to the news and all the things on it from there and other things going on. I'm not even sure if we are in recession. Have we been? Are we almost? Will we be? The BBC would be in a recession 6 times, but then they revised it. Where are we with recession? How long do you think it might happen, and what impact? Or is it all over now and we're out the other side?
Yeah, it's, you know, it doesn't help as well, because, you know, you hear people about hard landing, soft landing, no landing. It's like, well, what does that mean to the general population? You know, they sort of use this analogy of an airplane landing on the runway being sort of zero growth. Hard landing is, well, you crashed. Soft landing is, well, you just hit the runway a bit hard, but you didn't crash. And no landing is, you don't bother to land and you carry on growing, as it were. At this moment, I think technical recessions, 2 consecutive quarters of negative growth, we technically haven't hit that yet. People's pockets recessions, inflation's going through the roof, and people are definitely feeling the pinch of what they used to be able to buy with their £10.
But I also probably slightly challenge that, Shane, as well, in that, you know, our experience, you know, we took the team out for a night out last week in Leeds on a Wednesday night, and everywhere we went past in the Leeds City Centre, restaurants and pubs were packed on a Wednesday night. You know, you're trying to go out a weekend, most restaurants are busy. You go shopping, shops are full, and people are using carrier bags. So despite all this cost of living crisis that's always in the, and I don't like the word crisis from there, that the news uses a lot. It's back to the emotive words that you said.
Absolutely.
The reality on the street doesn't seem to match that.
No, it's a really good point. Really good point. It's, you know, I was in London yesterday, and surprising how busy it was, and people are still moving on with their lives and everything else. Recession wise, I got a sneaky suspicion, and this is not the company view. This is my own view. I got a sneaky suspicion. I think we'll avoid a significantly horrible recession. I think we might get mild downturn. But I think, central banks in raising rates, what they've done, they've refilled their ammunition. So if they need to stimulate the economy again, because they've been trying to slow the economy down in order to curb demand, in order to try and bring inflation down. With inflation coming down, and it's already coming down, so even if the central banks don't do any more rate rises, inflation is going to naturally come down anyway. And I think it'll be in a situation where they'll start cutting rates to stimulate that economy again. So I think if there is a recession, I don't think you'll notice, and I think it will be super mild. And I think you'll be in a situation where the unwind from COVID stimulus is going to be a bit like when I'm on a go-kart. I'm slewing to the left and slewing to the right, and eventually I'm trying to get it back to an even kill. So they went way too far with positive stimulus. They've arguably gone way too far with restricting that stimulus. So they're going to have to reignite with a little bit of cutting of interest rates. And I think they'll be happy to get to a level where inflation sits at maybe around 3%, and they can have real positive interest rates. And I think, everyone will be happy on that level. I think they're going to try and avoid to get back to this environment, Andrew, where for far too long we've had zero interest rate environment. Prior to the global financial crisis, you were getting 5% from your bank, and inflation was sitting at around 2.5%, and cash as an asset class made sense. But since global financial crisis, over the better part of nearly 15 years, we've been in a situation where nobody invested in cash. I think in the US, the average interest rate on a current account is something like 0.25%. That's nuts when you consider they're at nearly 4.75% with average interest rates. So yeah, I think we'll slowly get there, and I think this is an environment where you can make some serious returns because of, and you quite rightly pointed it out, because of the investments you've made now, and I think that's the key.
Yeah, no, and I think probably just last thing to finish on from there, we just talked about interest rates, and obviously interest rates have gone up. We're seeing people now to do a 5-year fixed rate mortgage about 4%.
Yeah,
it's up a little bit more, and that's causing a lot of worry and concern for people. But the reality is, it needs to be about that level going forward for a long time. You and I are both a bit older and grayer, and I know a number of clients similar that rates of 10%, 12%, 14% easily remembered. For the last 10, 15 years, interest rates for a mortgage of 1.5%, 2% is what people have got used to, but it's been just too low. That's meant savings have earned nothing. So it does have to have a bit of interest in there. People need to earn money on their savings and need to know about it when they're borrowing, so they don't borrow just for the sake of it, which has fueled a lot of increase in prices, especially on houses, as people have overbought because of cheap credit. So I don't think it's going back to 2% any day soon. If it stayed 3-4% for the next 5 years or so, I actually think most people will generally be happy, because
I totally agree.
It would come out a bit better.
That's a manageable level and a healthy level for the housing market.
Yeah.
Hurts if you've been used to 1.5, but as you say, if you've got longer memories, it's considerably better than 10. Yeah,
definitely. Well, thank you very much, Jane. I'm just going to finish off with a couple of items I'm going to share with everybody just before we finish. So if you'll just bear with me, everybody, on it from there, I will just share these with you very quickly. So just a little bit on information that's available for you. We've had quite a few clients recently that have been reading the Enough book that we've made available on our website that talks about financial planning. And they've been sharing it with their friends and family that want to do financial planning but don't really understand exactly what it is. And they found that a really good read. So it is available free on our website. So do have a read of it. Happy to hear any feedback that you've got. But generally, we've found, especially new clients that have come to us, have found that really enjoyable read, and understanding what they're doing and help them talk about some of the things that they want to do and achieve in their lives financially. There is also as well the free sort of financial planning software we've got for those starting the journey as well. But more importantly, for most people today, we do have every month a new guide that we add to our library on the website. So last month we did add a tax year end planning guide to there, which will complement what you'll have heard earlier today. So by all means, go have a look. They're free to download and quite a nice, easy read over a cup of tea. So what's next? As I've said, as you leave, you'll be prompted for to do a little quick feedback for us. We'd find that really useful to help us shape future events for you. So if you can quickly fill that in, that would be great. If you've got any suggestions for future topics you'd like us to do on the webinars, please do let me know. We do plan to record it today, and this time I managed to press record at the beginning because I forgot last time. So we've recorded it all the way from the beginning. We will be sharing that later. So if you want to come back and pick up on any of the topics that we've discussed, then by all means, you'll be able to do that or share it with family and friends. And then just a final bit then, what we call save the date. We are planning to do our next face-to-face client investment seminar on the 28th of June, returning to Hazel Castle. We have a new speaker lined up this time that we think will be very exciting, and I will be sharing more details nearer the time. But if you would like to, mark out that time in your diary, I think it's 4 o'clock that we've scheduled for the event to be, and obviously we'd love to see you all there face to face. And that's it from me. As usual, you've got the normal statement that we have to give about investments, but I've hoped you found today's investment seminar and tax year end planning seminar very useful. And obviously, thank you very much to both Shane and Dan for what they've done. So thank you, everybody, and have a lovely rest of the week.